S&P 500 Futures Defined Volatility Indices, a dynamic approach to volatility management. A common trend for all investors is to seek out sources of stable risk exposure, especially when markets are volatile and outlooks are far from certain. S&P Dow Jones Indices, a leading provider of multi-asset indices for use in structured products, created the S&P 500 Futures Defined Volatility Indices to help market participants seeking to target a predefined elevated volatility level systematically, in order to align investments with risk appetites and remove the need for timing the market. This dynamic, rules-based approach to volatility management seeks to maintain a predefined level of implied volatility of either 25%, 30%, or 35% by applying leverage, which is calculated based on the current weekly implied volatility of the S&P 500. Unlike realized volatility, which is backward-looking and represents the historically observed movement in the price of an asset over a given period of time, implied volatility reflects forward-looking sentiment of potential market movements. The indices are available with and without a decrement of 3% per year, deducted daily. So how do the indices work? On a weekly basis, the S&P 500 Futures Defined Volatility Index family measure the implied volatility of the S&P 500 via S&P 500 index options, and then deploy a rules-based methodology to apply leverage of up to 4x or 5x on the underlying S&P 500 Futures 3-day roll index in order to reach their defined volatility levels. The indices have a built-in circuit breaker that floors the index level from the prior rebalancing at 75%. Historically, the weekly rebalance has responded quickly to anticipated changes in the market, helping the indices maintain their predefined target volatility. By tracking a range of target volatilities, the index family is not only helping define a previously undefinable pricing metric in implied volatility, it is also serving as the foundation for new tools designed to help market participants align investments with risk appetites. How does the Defined Volatility Overlay work? The Defined Volatility Framework is applied to the underlying index and helps target more stable volatility. When the implied volatility of the S&P 500 is low, the Defined Volatility Overlay increases the exposure to the underlying index up to the corresponding leverage cap. As implied volatility increases, exposure to the underlying index decreases. So what's the end result? Historically, the Defined Volatility Overlay has created more stable realized volatility levels for its index series compared with the S&P 500, helping the indices to deliver a consistent risk profile. To explore the volatility, decrement, and leverage cap characteristics of the S&P 500 Futures Defined Volatility Indices, and to learn more about both the decrement and non-decrement versions of the indices, visit us at the link below.